I have spent decades analyzing sovereign debt cycles, and I can tell you with absolute certainty that the United States has entered a phase where escape is no longer mathematically possible through conventional means. This is not a political statement or an emotional prediction. This is arithmetic. When debt grows faster than the economy that supports it, when interest payments consume an ever-increasing share of revenue, and when political constraints prevent meaningful reform, the outcome is predetermined. The only variables are timing and the specific form the resolution takes. The numbers tell a story that most people prefer to ignore because the implications are uncomfortable. The United States national debt now exceeds $35 trillion. This represents roughly 130% of GDP, a level historically associated with crisis in other nations. But raw debt numbers alone do not capture the full picture. What matters more is the trajectory and the sustainability of that trajectory given current policies and constraints. Debt is growing at approximately $2 trillion per year under current projections. Meanwhile, nominal GDP growth averages around $1 trillion annually in favorable conditions. This means debt is accumulating twice as fast as the economy is growing. In any system, when liabilities expand faster than assets or income, the end game is insolvency. The only question is how long the process takes and what form the final resolution assumes. Interest payments have now surpassed $1 trillion annually. This is more than the United States spends on national defense. It is more than the entire budget for education, infrastructure, and scientific research combined. And this is with interest rates still below their long-term historical averages. Every percentage point increase in average borrowing costs adds hundreds of billions to annual interest expenses. As older debt matures and must be refinanced at higher rates, this burden grows automatically regardless of any new spending decisions. Here is where the trap closes. To control inflation, the Federal Reserve raises interest rates. Higher rates make new borrowing more expensive and increase the cost of rolling over existing debt. This forces the government to borrow even more just to pay interest on what it already owes, which increases the deficit, which requires more borrowing, which increases interest costs further. This is a self-reinforcing spiral with no natural exit point under current policy frameworks. The political system cannot resolve this because every available solution is unacceptable to critical constituencies. Cutting spending meaningfully requires reducing entitlement programs like Social Security and Medicare, which are the largest components of the budget and also the most politically protected. Any politician who proposes significant cuts faces electoral punishment. The math of demographics makes this worse. Every day, more than 10,000 Americans turn 65 and become eligible for these programs. This trend continues for another decade at minimum. Spending grows automatically regardless of policy preferences. Raising taxes high enough to close the deficit would require increases so substantial they would devastate economic growth and trigger recession. The wealthy can relocate or restructure their affairs to avoid confiscatory taxation. The middle class cannot bear significantly higher burdens without political revolt. Corporate taxes above certain levels drive businesses to relocate operations or invert to foreign jurisdictions. There is no politically and economically viable tax increase large enough to solve a $2 trillion annual deficit. This leaves only three possible outcomes. First, explicit default, where the government announces it cannot or will not repay its obligations. This is theoretically possible, but practically suicidal for a reserve currency issuer. It would destroy the dollar's global status overnight, collapse the treasury market, and trigger a financial crisis that would make 2008 look manageable. No rational government chooses this path voluntarily. Second, dramatic austerity, where spending is cut and taxes are raised enough to create surpluses that gradually reduce the debt burden. History shows that democracies almost never choose this path because it requires sustained political will across multiple election cycles and inflicts immediate pain on voters in exchange for long-term benefits they may never see. Greece was forced into austerity by external creditors who had leverage. The United States has no external creditor with that kind of power. It borrows in its own currency, which means it can always print money to service debt rather than default explicitly. This brings us to the third and most likely outcome, inflation. Not hyperinflation necessarily, but persistent elevated inflation that erodes the real value of the debt over time. If the government owes $35 trillion and inflates the currency by 50% over a decade, the real burden of that debt falls significantly even as the nominal amount stays the same or grows. Creditors get repaid in devalued currency. This is effectively a hidden default, a transfer of wealth from lenders to borrowers, from savers to debtors, but it happens slowly enough that it can be politically managed. The Federal Reserve faces an impossible dilemma. Its dual mandate is price stability and maximum employment. Right now, these objectives conflict directly with fiscal sustainability. If the Fed keeps rates high enough to truly control inflation, say 6 or 7%, the government's interest burden becomes unsustainable and recession risk spikes. If it keeps rates low to protect the economy and make debt manageable, inflation persists or accelerates, eroding purchasing power and currency credibility. There is no neutral position where all objectives are satisfied. Every choice involves sacrificing one goal to protect another. This is the defining characteristic of a late-stage debt cycle. The room for error disappears. Policy becomes a series of forced choices between bad options, each of which creates new problems that compound over time. I have studied how this pattern played out elsewhere. Japan, after its 1990 bubble burst, borrowed aggressively despite debt exceeding 250% of GDP. It avoided crisis by borrowing from its own citizens at near zero rates, but paid with 30 years of stagnant growth and diminished prospects. The central bank now owns nearly half of all government bonds. This works until inflation forces rate increases, making the debt burden crushing. Rome provides deeper historical perspective. Facing mounting costs and declining productivity, emperors debased currency by reducing silver content in coins. This created inflation that eroded savings and destabilized the economy, destroying trust in institutions without solving underlying fiscal problems. The pattern is consistent across time and geography. When governments face unsustainable debt and lack the political will for austerity, they choose inflation. It is the path of least resistance because the pain is diffused across the entire population rather than concentrated on specific groups. Savers and fixed income recipients suffer, but they are less organized politically than the beneficiaries of government spending. For the United States in 2026 and beyond, the trajectory is clear. Debt will continue growing faster than GDP. Interest payments will consume an increasing share of the budget, crowding out productive spending. The Fed will face persistent pressure to keep rates lower than inflation to prevent fiscal crisis, which means real rates stay negative. This environment systematically transfers wealth from holders of currency and low-yield bonds to owners of real assets and productive equity. The demographic wave makes this worse. Social Security and Medicare face funding shortfalls as the ratio of workers to retirees declines. These programs are pay-as-you-go systems, not funded pensions. Current workers pay for current retirees. As baby boomers fully enter retirement over the next 15 years, the math becomes increasingly untenable. The only way to maintain promised benefits without massive tax increases is through inflation that reduces the real value of payments. Politically, neither party has demonstrated willingness to address this honestly. Republicans resist tax increases and Democrats resist spending cuts, which means deficits continue regardless of who holds power. Proposals to reform entitlements face immediate backlash. The political incentive is to delay, to pass the problem to the next administration, to hope that growth or unexpected revenue solves the issue without difficult choices. But hope is not a strategy, and the math does not care about political preferences. Compounding works in both directions. When debt compounds faster than growth, the gap widens exponentially. What seems manageable today becomes crushing within years. Japan took 30 years to reach its current predicament. The United States is on a faster timeline because it starts from a weaker fiscal position and faces larger external constraints. For individuals, understanding this trajectory is critical for protecting wealth. If the government will inflate away its debt burden, then holding wealth in currency or low-yield fixed income guarantees real losses. Every year that inflation exceeds your return, purchasing power erodes. This is not hypothetical, it is already happening. Official inflation may be reported at 3 or 4%, but real inflation in essential categories like food, energy, housing, and healthcare is higher. Asset allocation must reflect this reality. Real assets that maintain value through currency debasement become essential. This includes equities in companies with pricing power, real estate in supply-constrained markets, commodities with durable demand, and inflation-protected securities. The exact mix depends on individual circumstances, but the principle is universal. Do not hold wealth in forms that will be systematically devalued. The other critical insight is understanding that this is not a short-term problem with a quick fix. This is a multi-decade transition. There will be periods where markets rally on hope that policy has shifted or growth has accelerated enough to outrun the debt. These rallies create opportunities to rebalance and take profits, but they do not change the underlying trajectory. Structural problems require structural solutions, and structural solutions require political will that does not currently exist. International implications are equally significant. The dollar's reserve currency status depends on global confidence that the United States will maintain fiscal discipline and currency stability. As that confidence erodes, alternatives gain traction. China, Russia, and other nations are actively building systems to reduce dollar dependence. BRICS expansion, bilateral trade agreements in local currencies, and central bank diversification away from dollar reserves all reflect this shift. The dollar will not collapse overnight. Reserve currency transitions take decades, but the direction is clear. As U.S. debt becomes less sustainable, as inflation persists, and as political dysfunction prevents reform, the incentive for other nations to hedge their exposure increases. This creates a feedback loop. Reduced demand for dollars and treasuries makes financing the debt more expensive, which worsens the fiscal position, which further reduces confidence. The United States retains significant advantages. It has the world's largest economy, deepest capital markets, strongest military, and most innovative technology sector. These are not trivial, but advantages can be squandered through poor policy and fiscal mismanagement. History is full of empires that possessed overwhelming strength yet declined because they could not adapt to changing conditions or address internal contradictions. The debt spiral is one of those internal contradictions. It cannot be ignored indefinitely. The longer solutions are delayed, the more severe the eventual adjustment becomes. At current trajectories, within 10 years, interest payments could exceed all discretionary spending combined. At that point, the government would be borrowing just to pay interest while having no fiscal space for defense, infrastructure, education, or anything else beyond mandatory entitlement programs. This is not sustainable. Something will break. Either policy changes dramatically, which requires political transformation that seems unlikely, or the system adjusts through inflation and currency devaluation, which is the path of least resistance. Those who position for the second scenario while hoping for the first will be better prepared regardless of which outcome materializes. The window for easy solutions has closed. The debt is too large, the political divisions too deep, and the demographic pressures too severe for painless adjustment. What remains are choices between different types of pain, different distributions of losses, and different timelines for resolution. But avoiding pain altogether is no longer an option. The math has already determined that. For those watching this unfold, the imperative is to understand the mechanism, accept the reality, and position accordingly. Do not wait for confirmation from officials or consensus from media. By the time the problem is widely acknowledged, the adjustment will already be underway and repositioning becomes expensive. Markets move ahead of recognition, not with it. This is not pessimism. This is realism grounded in historical pattern recognition and mathematical necessity. Debt spirals end, they always end. The question is not whether, but when and how. And for individuals, the question is whether you prepare before the ending becomes obvious to everyone, or whether you wait and become part of the wealth transfer that inevitably accompanies these transitions. The debt-death spiral is not a future risk. It is a current reality. The only variable is how much time remains before the consequences become undeniable to those who currently prefer not to see them.